What's up, everybody? Welcome back to Retail Weekly. I'm Ronnie V. This is Knots. This is our second week doing this in a row, actually under the umbrella of Retail Weekly. Today, we're going to be talking about OSCR ZETA HIMS Rivian, and then we're going to get a little bit into a new gem that I found already. Already shared it to the High Five community, so they're already aware, but I wanted to bring it out to everybody's attention. We'll get to that later in the video. Just, right off the bat, we got to talk about this market just pumping up here on a half day. Absolutely crazy. It's kind of giving me goosebumps here that they're setting us up for after 4th of July dump. But did you know, Knots, that every single July has been a green month pretty much?
I did not know that, but we talked about it on the spaces today that
Oh, really?
every single I said it yesterday too, like every July 4th, the whole week has been absolutely phenomenal. And today was just another thing. I bought every dip today. It worked out perfectly.
Yeah. I personally didn't do any trading today. I kind of went into today just like, what? I'm already up on the week. I'm just going to, relax. I'm going to look at my overall portfolios, investment portfolios and everything, really focus on that and just kind of take a break. I thought the volume would be super low today. It got there later in the day, but in the beginning of the day, it was actually fine. I mean, there was no issues with the volume, so you definitely could have traded this market. Not mad that I didn't. The move kind of already started pre-market and then just kind of continued up. Yeah. So that is crazy, America, right? They're just like, yeah, 4th of July, Independence Day. Every July is just going to be up and everybody's going to make money. Love that for July. I mean, I guess we just got to jump right into it, right? We got to talk about OSCR. We got to talk about it. It went from a nobody knows this stock, me, you, and the long investors started talking about this thing beginning of the year. We were buying it, basically in the 10s, up to about 15-ish. I'm still a buyer here. I don't know about you. I'm still a buyer here, honestly. I don't see any reason. Even in the 20s up here, I was a buyer. So let me share my screen. I'm just looking at this for the long term. And I get, if you're like, and I made a post about this yesterday. If you're a trader, be a trader. If you're an investor, be an investor. Invest for the long term, 1, 3, 5, 10 years, right? If you want to do both, understand and learn how to separate both of them. Don't trade your investments and don't invest in your trades. I think that's a really good analogy for anybody, because here's the thing. I'm looking at OSCR and I already understand how deeply undervalued it is, below 20, even below 25, right? So I get people are sitting here like, oh man, I bought the top at 22. I don't think it's going to matter when it's 45 in the next, 1, 3, 5 years. You know what I mean? No one's sitting there on Palantir saying, oh man, I bought it 25 instead of 20. It's 140 some. Come on.
Yeah,
everybody wishes they bought at 5, but you gotta think long term if you're gonna play this game for investing. If you're trading it, you should have sold into resistance. This was very key resistance. I posted this El Resistance 22 to 23-ish, right? It was clear resistance. If you're trading it, you gotta get out. That's why you can't mix oil and water, right? You can't mix your investments and your trades. You got to keep them totally separated, guys. Because if not, then you go from an amazing 55% run on this trade in a week, and you should have locked in profits or sold or something. And then now you're sitting here fumbling around and saying, okay, now I'm down on the position. Now I need to switch it to an investment. And now I need to learn everything I need to learn everything about OSCR. I need to learn about ACA. I need to learn about all of it, right? So I think that's a mistake, though. You shouldn't buy into a company and then learn about the investment later. You should learn about the investment first and then buy into it, right? And that's why you can't go from a trade into an investment or investment into a trade. It's just not good overall anything with money management at all. What do you have to say about all of that, or what's your views?
Yeah, so to me, it's an undervalued company. I bought more shares at 17.50. I think like 18.12. I'm planning to buy more, but I also bought September 19th calls. I bought March of 2026 calls. So, I've got some decently, well, I mean, the September is only 2 months, but the March is another, what, 8 or 9, whatever it is. I don't even know. So I'm set up in that way. I bought a bunch of shares. I did sell some covered calls on the pop yesterday, which seemed to have worked out. So I made a little extra coin. But yeah, I mean, to me personally, I feel like Oscar has 100% potential, and I'm going to take advantage of these dips.
Yeah,
and they
100%.
affirm guidance too. So I mean, yeah.
Did they just come out with that?
What?
Did they just come out with that? The firm
No.
guidance?
They
Or are you talking
reaffirmed
about
guidance
just?
from the last earnings. Yeah.
Yeah. Okay.
Yeah.
Just track. I didn't know if there was something new.
Okay.
Yeah. I mean, I'll pull up on the stage. There was a term in the Air Force that we love to use, army proofing. Basically, army proofing something to where basically you make it so simple that the weakest person on the team could understand it. And I made this post earlier today, as you can see on the screen. It's just what you were saying. They reaffirmed this guidance. This was from their last quarterly, and I dummy proofed it, right? Individual market growth is sustainable. Keyword sustainable with additional upside. So separate from the sustainable, additional upside if enhanced subsidies extend beyond 2025. It's not the end of 2025 yet. I understand that we have this bill that's almost passed and blah, 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 the big, beautiful bill, right? But it's mainly attacking Medicaid. Medicaid redeterminations, 1/3 of those who lose Medicaid because Oscar doesn't deal with Medicaid, they deal with ACA, Affordable Care Act. Eligibility are estimated to be eligible for ACA premium tax credits, right? And the thing people don't realize is ACA is not going away completely. It's just some subsidies inside ACA that make it, more affordable, obviously, and allow people to go after, basically make it cheaper for people to have health insurance, right? But the thing people don't understand is if this bill passes and all this Medicaid takes place and all these cuts in Medicaid takes place, all premiums are going to spike. So them getting rid of the ACA subsidies is very you can easily compare it to the Medicaid cuts, right? Because it's not just ACA becoming more expensive, right? With the subsidies going away, it's also all health insurance becoming more expensive with all the Medicaid cuts, right? So basically, it kind of evens out, in my opinion, evens out to a level playing field here for all companies. So ACA is not completely going away. It's just everybody's scared because it's going to spike premiums for all health insurance, unless the government does something about this, which I think they will before the end of the year. But if they don't, people need to realize that yes, 96, 97% of their revenues come from ACA, but it's not ACA just being thrown out the window at the end of 2025. It's literally some subsidies. It's some pieces of ACA becoming more expensive or getting trimmed out, right? So tax credits, with states paying some of it, with federal paying some of it, people's medical insurance. You see what I mean? So people really need to understand that this right here is from Oscar. It is from their management team. It is saying, hey, if ACA subsidies do not get extended and they go away at the end of 2025, in 2027, we will still project a small dip, right? A small dip from what they were doing in 2024, but actually they're going to recoup all of that and have a larger revenue basis, right? In market size with that ICRA, with ICRA expanding. And honestly, I think, the thing about any company, any good company, they're going to come in and they're going to be more safe than sorry, right? When you're playing the Wall Street game, you do not want to come in and shoot for the moon. You want to say, okay, well, what's worst case scenario, or like what's a little like conservative assumption on what we could do. That's where they're coming in at, and that's what I think they're coming in at here too. So I don't think this really takes into consideration, all the business they can get from the Medicaid cuts as well, and how fast they can expand ICRA. 171% growth of employees offered ICRAs between 2022 and 2023. So that's only expanded since then, and that's continuously growing. So what's your views on all this?
And again, this is from
Nick?
them, correct? Obviously, it looks from their colors.
This is straight.
Yeah.
I just dolled it up with some basics. But yeah, this is
Yeah.
straight from Oscar Health Investor Relations PowerPoint from the
Yeah, and this is
last
kind of
quarter.
what I was talking about before, and I've said this in multiple posts. So again, CNC, which is another healthcare company, took away their guidance. Okay, that's obviously why the market, not the market. That's why these individual stocks fell. Oscar, UNH fell.
Yep.
Some of the other healthcare names. Again, I just said this a few minutes ago. Oscar affirmed their guidance and basically priced in, if things were to be removed or changed, So me personally, I again am a buyer. Nothing has really changed. I kind of relate it. And I think we do this almost every week, but I kind of relate this to HIMS, and you
Yeah.
could kind of relate it to the GLP-1.
Yep.
Yeah, I don't see a difference here. I really don't see a difference here. And after all that GLP-1 scare, it went from 17 to 70. I'm not saying Oscar is going to do that, but I think this is an opportunity for myself to buy. And if you love the company, if you do your due diligence, I think it's an opportunity for other people to buy. Again, you get these opportunities and you got to take advantage of them. That's the key of being an investor. That's the key of being a trader and just in general, if you're just trading. So, this is another opportunity for me. And I took advantage. I bought shares. I bought leaps. I bought calls. I'm just going to be doing whatever I can and making money off of it.
Yeah, people think, I'll wait for it to come back down here to $11 to $12. The cat's out of the bag, guys.
Yeah.
I mean, I would personally love, and this is what every investor should want. You should want Oscar to go back to 11 or 12, 100%. People will send me a comment or something on an Oscar post, because now it's not all rosy and sunshines, right? Oscar's not just going up and up and up every day. We're not up 100% now. We're only up like 30 some percent or whatever since we were calling this name out. Whatever. But the trolls come out, the people come out. Oh my God, look at you, blah blah blah. Whatever. Go touch grass. The biggest thing is that the cat's out of the bag here, right? You are most likely not going to go back to 11s or 12s. At 11s, even down to 13s, that was just like the pricing on this company was just it's really really bad right now, like how fundamentally undervalued it is. But down at like 11 to 13, it's just like, honestly, like they could basically sell all their assets and take in all of their accounts receivable, and they pay off their company, if not more, and then they give that money out to all the shareholders. So it's you know what I mean? So it's actually insane down here at these levels that you're probably not going to see, guys. Like the cat's out of the bag here. I wouldn't be surprised if Wall Street and some of the hedge funds are loading up at these prices. And trying to time this stuff, guys, again, like, okay, I'm gonna sell out here because this is my cost basis, and because I want, I'll break even now, and then I'll get back in, at 13. Well, what if 13 never comes, and then we go to 50, 1, 3, 5 years, and then you're sitting there like, man, I can't believe I owned it at a 16 cost basis, but I sold out because I was trying to get $3.
Yeah.
$3 cheaper. Guys, you do not time investing. Time trading all day. You do not time investing. Okay? So yeah. I mean, guys, the super basics, it's just silly. And if you want to look at the bull case here, I posted this as well. One of the biggest bull cases here is 2 million members. 2 million members is less than 1% of the US population. They're only in 18 states, right? Yep, 18 states. They're only in 18 states. And there's approximately 347 million Americans. and they have less than 1%. If they get up to 3%, that's 7 million Americans. That brings their 9.2 billion revenue up to 27.6 billion for a 4 billion market cap. It's already silly that they're at 9.2 billion and a 4 billion. They're actually under a 4 billion market cap today. It's like 3 point something, but I digress. Just silly, guys. And they're, again, going back to what we said before, they're expected to grow still from here to 2027. They're still expected to grow revenues. They're still expected to grow free cash flow. They're still expected to grow the bottom line, net income, EPS. They're still expected to grow all of that, even without ACA subsidies. You want to really see this thing explode? You want to see people like your September options bull? My goodness, if we get an extension on ACA, my goodness, you're gonna see 1,000%.
Oh no, it's gonna go wild. It's gonna go wild.
It's gonna be crazy, crazy. Because if that gets extended, like even for a year, I don't care if it's 3 months that it gets extended. That's literally giving them another 3 months, 6 months. And this company right now is priced for, they're gonna lose all ACA. They're going to lose all 2 million members. They're not going to get any more members. They're going to just lose all 2 million, and they're not going to grow, and they're just going to go bankrupt, even though their cash position is pretty hefty as well. And I get health insurance in their cash position. I understand that. For all the bears out there that talk about that, I understand that. But you just got to realize how undervalued this company is. I mean, pull it up on the high five snapshot, guys. We're talking about 5 to 10% free cash flow margin rates for the next 10 years, essentially. If I went through and I just knocked all this down to a zero, right? If I just knocked all this down to a zero, oh my goodness. Oh, zero revenue growth. They just stay where they are right now. 5%, it's still $32 you should be paying. I mean, how do you do that? How do you go 0% revenue for the next 10 years? Like,
that's a dead company, which this is
dead company. That's a dead company right there. I mean, geez, guys. And like these assumptions, I beat it up. Like I beat up these assumptions. Like these aren't even like this is -2, 14, 10, 8, 12, 8, 10, 6. I think they can actually grow 20% plus growth for the next 10 years. I really do. That's my bull case. 20% plus growth for the next 10 years. You want to get real crazy? You want to get real crazy on how undervalued this company is? If you get rid of all the BS, $127 on a discounted cash flow model. Fair value today, not 10 years from now, today, if they were to grow 22% or 20% or whatever.
What'd you say? 100 what?
What's that?
What'd you say the price was?
127. I mean, it's like over a 10x.
I like that.
Today.
Let's do that today. How about that?
Yeah. And again, so this intrinsic value right here, that's literally talking about, okay, what is the fair value today based on your assumptions of, say, 20% revenue growth? Let's just say they did 15% revenue growth for the next 10 years. For the next 10 years, if they did 15% revenue growth, which I actually think is conservative, you're looking at $81 fair value today. Okay, let's drop this down to a 2. Let's drop this down to a 3. 2% free cash flow margin rate. That means, so out of this revenue at 15% revenue growth rate, they're only getting 2% of that revenue down to the free cash flow. 2%. And then in the last 5 years of the 10-year analysis, they're only getting 3%. And currently they're doing like 10%. 10% right now. Still a $28 fair value today. I mean, I'm kind of scared to do this. 0%. See what it does. Okay. So let's say, oh my gosh, they only get 2 to 3% revenue margin rate, right, for the next, 10 years. And basically they get 0% revenue for the next 10 years. 0% revenue for the next, there's a dead company. It's still a $14 fair value. $2. This is what we're talking about. This is why I continuously say this might be the biggest risk to reward stock in the entire stock market. The risk here is that if they sold off all their assets, if they received all their accounts receivable. They settled all their insurance claims, and they basically said, you know what, we're going out of business. Go find health insurance somewhere else. People, we don't care anymore. We're done, right? And they sell any, I don't know, whatever they have with their AI, if they have any licenses or whatever, right? They sell those as well. You know, basically here at 0% revenue growth, basically you're still going to get, you know, I'd probably say a little less than 14. I'd say like 10 to 12 bucks a share for this company, like basically wrapping it up, have a fire sale, sell it all. And then as an investor, you're still only losing $6 from today. Like that's the risk. That's the risk. That's insane. Is that not insane, Knots? That is insane. My goodness. So people are sitting here like, people don't realize that, guys, they already have this stock price for doomsday. They already have this stock prices as if like they are going to just, you know, implode. You know what I mean? So yeah. I guess the only thing I could have done here, right? You know, 0% revenue growth. Like let's, you know, if they stayed at 9 billion, you know, obviously they would have to continue the 9 billion revenue growth. So if they were to implode and then, you know, basically come down on that, then there's that risk as well. But again, like this isn't, they're not just like going away with all this. You know what I mean? So
correct.
Yeah. All right. I think that's enough about Oscar. That was a solid 21 minutes, but hey, it's the main stock. Me and you talked about it. It's the main you know, we talk about gems, we talk about great investments, we talk about great companies that me and you really like. At the end of the day, like me and you talked about it, Oscar is number one, bar none. It like you don't come around these situations often, you know, you really don't. So to have this opportunity for all those people that missed out, that didn't get the buy-in, yeah, it's insane. Who should we go to next? What stock should we go to next? Zeta?
Let's go over Rivian just really quick.
Yeah.
Rivian just got $1 billion worth from Volkswagen on June 30th at a 33% premium of the volume weighted average price over the prior just about 5-week period. That came out to 1943. So Volkswagen had to buy $1 billion worth at $19.43. So that is interesting. They had delivery numbers, and Rivian, for the first time ever, actually delivered more luxury vehicles than Tesla in a month.
Dang.
So that is very interesting.
So I see they're still hanging on here to. They're still hanging on to that retest area of this symmetrical triangle pattern, which is really nice because essentially you had this downtrend from 2023. Wow. And you broke out of that, which is very bullish. And now, as long as they can hold here, I mean, on a technical standpoint, you know, if they can hold this and you have this nice volume shelf too, then yeah, you should be able to take a nice ride up to this, you know, $16 to $18 area. So
I like the sell a kidney spot.
Yeah, sell a kidney. I mean, you know, you look at this level. This is, you know, April 2024 low, so not even like this past you know, tariff bomb, right? I mean,
look at the higher low it's just going across.
Yeah, exactly. It's just climbing up. So, I mean, if you got down here, it would take a lot, in my opinion, to break this $8 level. I mean, they would have to start all the progress they've made, all the great things they've been doing. They would have to start just like imploding, self-imploding. Like, oh, nope, that's not going to work. That's not going to happen. Blah, blah, blah. Let's see. I think we did have a question in here about a couple. I know it's tough to say, but do you see us getting another pump in the next month? Got some calls expiring 7/18 and 8/8. I think.
I do think there's going to be a bounce.
Yeah, I do think there's.
What's the strikes, Cameron? That would also help, I guess.
Yeah, Cameron, let us know what the strikes are. I'll kind of talk about it while you put that in the chat. I think the key thing is if we look at the if we look at the weekly chart, you know, you have this bull flag breakout, which is also the handle of the cup and handle. And yes, you are deeper than the actual line, but here's what I always tell everybody. You're not just going to get, most of the time, you're not just going to get a perfect, like, boop, hit the line and then go. Remember, this is just a line that's just drawn on a chart, okay? Like, it's not like some like magical you know, force field that's just like, nope, let's pump that up right there. Okay, so I've seen it multiple times with SoFi, Hims, and all these other companies. Like, it'll come down, it could come down here, but the biggest thing is you want to see right in this area a bounce eventually. $16 for 718 and $17
Those are good
for
strikes.
88.
I mean,
Yeah, those are
wrong
solid. I do believe we're gonna get a bounce.
Mm-hmm.
And when we do, I would get out of those close to break even as possible if I was you. I just think there's not enough time, right? For those. Just being completely honest. I don't think you're gonna make a lot of money on those unless we get some crazy, like, ACA gets extended, or you know what I mean? It's the same thing with like Hims right now. Right? It's the same thing with Hims. There's a lot of negative pressure down on Hims, and it's going to take something vast for them to kind of get back on an upward trajectory. I think for Hims and Oscar, there's more downside potential and risk than upside right now, just because the environment, like, these swings come and go. Oscar and Hims are hot. They're doing everything right. They're making deals. They're killing it on their earnings. And the next thing you know, the pendulum swings back in the other direction. Hims is dying. Oscar's dying. They're zero revenue growth. Blah 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 blah. Amazon's gonna eat their lunch. UNH's gonna, come on. You know when you should be buying? You should be buying over here when everybody's like, "Oh my gosh, like, this company's dead." Blah 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 blah. Do your research. Run your numbers. And again, like, I keep on saying, like, Oscar's a buy up here, Hims is a buy up here. Yeah, if you aren't invested in them at all, like, yeah, everybody would love to go back and buy in the 12s or 13s, or for, you know,
I'd love to go back and buy more.
Yeah, exactly. Everybody would love that. But the thing is, you know, because people, you know, everybody gets on you about, you know, why are you saying buy in the 20s whenever you're buying in the 12s and 13s? Why are you still buying? Because I still think it's very undervalued. Hims at 40 some, 50 some, I still think is undervalued. I think it's $100+ company. Remember, these companies are massively disrespected. So yeah, for those options, man, there's just that negative pressure, meaning that any other news that comes out, any other, you know, idiot analysts that want to come out and write a hit piece on this company, it's easy right now. It's so easy to write a hit piece on Hims and Oscar right now. So easy. So yeah, let's see what else we got. How about the analyst attacking the CEO's guidance, basically calling BS on it? Well, I think somebody posted that analyst, and he has like a terrible rating.
Yes, he does.
Yeah,
very
terrible,
bad.
like a half a star rating. You know what I honestly think with these analysts, man? I think they just, like, these firms, they're like, who do we not like? who do we not like at this company, and who's just, like, terrible? We're gonna have them write the hit piece. Yes, it'll still have our name behind it, but if we get any slack, we could just fire this dude because he was already on the chopping block, or we can just say, you know, oh well, this guy, look, he's terrible. You know what I mean? So it's like, just give it to him. The same thing was for Hims, and there was a couple other hit pieces that people wrote, and it was just like these analysts that were just like, who? Like, look at, just terrible, man. So, yeah. Who do you want to put your money with, a CEO or analyst? I think everybody knows the answer to that one.
Definitely not an analyst for me.
Definitely not an analyst.
That is all I know.
Sweet. That's all the questions. Yeah, we can move. What else you got?
Yeah, I think it's only right we go to Zeta, especially after it had a very nice day until just about an hour before the close.
I think it's being suppressed for big money to get into this name. I think they're also, I would probably put that number 2 on my list right now to Oscar, to be completely honest. I mean, they haven't done their move yet, like, at all. Like, people think they have, but here, I'll show you it on the screen.
I mean, they had a great move to 7 to what, 37? and that was a while ago. Well, not a while ago. It was a year ago.
Yeah.
Not
So
even a year
here's my
ago.
thing. Here's my thing, right? They're priced back here. You know, this is 2022. They're priced back at,
Yeah.
you know, where they were then, right? And it's all, you know, similar to Oscar. They got some headwinds going on. They got a lawsuit going on. People are
Mhm.
worried about it. But again, they're priced because they have like a 40 some percent margin of safety right now based on a discounted cash flow model. And then based on their EPS, they're very undervalued as well. So they're also priced to where they're going to lose big money on this lawsuit. They're going to, you know, basically self implode. Like
Yeah.
same thing, but their revenues keep growing, their EPS bottom line keeps growing, their free cash flow keeps growing. So there's just another one, man. Like you can sit here on a weekly chart and say, okay, buying between 10 and, you know, right now 15, buying between 10 and $15, you know, you're limiting your downside because again, it would have to get really bad for them to get down to sub 10, I would say. Very bad. Like
Yeah.
you probably wouldn't want to own the company anymore. Or like macroeconomic issues, right, where the market just completely implodes from here, which I don't see that. Market's climbing higher. The only thing I see in the market is maybe a 5% dip to retest the breakout of all-time highs, like on the Qs. I could see that, and people would freak out, and then it'd be a good dip buying opportunity, and then we'd probably go back to all-time highs.
Yeah.
Yeah, like whenever you can buy on a good volume shelf, the biggest volume shelf of the whole company, and you can get in down here close to basically at its support area
From 2 years ago,
from
and
2
its
years
revenue has
ago
gone up. It's everything else has
substantially.
gone up.
Yeah, I mean, we could look at right here. I mean,
Yeah.
annual revenue 2 years ago, they were doing 590 million. Now they're doing over $1 billion. So they almost doubled their revenue.
In 2
But yet
years.
we're back. You like going in a time machine, go back to 2022, and you can buy it at those prices.
Yep.
And severely undervalued. So yeah, this is definitely number 2 for me. I really like this name. You haven't missed a move at all. You missed. You ready? You missed a massive move of 45%, right? If you bought the exact bottom, I didn't buy the exact bottom. I bought, you know, up around, you know, 14 to 17 in that range. And I don't care because I could see this thing going to 20, 30, 40. So 2, 3, 4x, right? From here. And everything's still trending up. I know we're hitting, you know, that 16's real resistance. I'm sure you're seeing that too.
Yeah.
Knots.
I got like
Way
1585.
Yeah.
1582.
Yeah, right there. And the reason it's such tough resistance is why? Because you had previous resistance, and then you flipped it to support, and then you broke through that. So now it's flipped back to resistance, and now you're sitting here waiting for it to flip. Basically, for you to conquer this again right here, get back up here and go higher. So for any resistance, you need to flip it to support, and the only way you can do that is breaking over it, retesting it, and then continuing higher. So 16's tough right now, but here's the thing: I'm sorry, that's 18. But yeah, we've had trouble at 16, as you can see right here.
Yeah.
Love that. Right here, you see these this like 3 wicks, 4 wicks, 5 wicks right there, right here up at $16. Real struggle getting through that. You know, volume is still high here though, right in this area. So I think there's a lot of accumulation going on. And then you will see a move eventually up here to this point of control up to about $17, $18 area. And then you can see more resistance at 18 to 20. But yeah, fundamentally wise, I think it's solid. I mean, we're talking about $26 is fair value right now on conservative assumptions. This company is going to be growing mid to high teens for the next 10 years. That's on analyst assumptions. And then their 2027 EPS would be about $21 fair value. Again, that's based on a 20 PE, which with these revenue growth rates, you can easily see like a 25 PE being for this company. So
Yeah.
yeah. You got any more about Zeta?
No, I personally love it here. I just think you had a dip from what, 1850?
Mm-hmm.
Yeah, 1820.
$3 off now. $3
Yeah,
off.
down to 15 or down to 1450.
Yep.
It's just holding the 90 MA on the daily too. I mean,
Yeah.
me personally, again, this is another company that I'm buying. Nothing changes. They're growing. They are expected to grow more. I mean, they're guiding up. I have no reason not to buy it. I feel they have a good moat. I love the leadership team they have. So yeah, I'm in.
Yeah, I really like it. I like it a lot. I think another great risk to reward ratio. Yeah, sure, you missed out on 45% from the exact bottom. We're not there anymore. But if you just look at the chart, there was a reason, right? There was a reason that in 2024, this company was $40. And I'm not going to sit here and say, right, this is very different. I will clarify this. If this was 2022, 2021, 2022, I wouldn't sit there and say there was a reason that this stock was $38. I understand that in 2021, 2022, things got very out of control. But this is just 2024, guys. 2024 in November. So yeah, we ran up and we got the all-time highs, but we weren't at any kind of blow off top or anything, in my opinion. So we're very far from that. And again, I have a fair value of about $26. So not even all-time highs, just back up to this resistance that we hit here. So yeah, I think it's just like when you get these stories of, lawsuits or like UNH is a great buy here. You get like the avalanche coming down and just smacking down on the stock, right? Like it's just getting buried in snow. When you get that, that is the time to buy, not whenever everything's rosy and everything's perfect and blah, 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 because that means everybody knows about it. You're only going to get super undervalued companies at a great price whenever there is negative news out there, more than likely, or people just don't know. People just don't know about it, right? In Oscar's case and Zeta's case, I think it's a combination of both. Less Oscar now because it's very popular now, and that's why you see it so resilient, in my opinion. And what do you think? I think with Oscar, I think we're pretty much at the point where a lot of the retail that I think we either capitulated already or close to capitulation with Oscar. I think.
Listen, I'd put it this way. Everyone know, like you were just saying, everyone knows about Oscar now.
Mm-hmm.
I feel like the craze was Zeta last week. And to be honest, I was a part of that craze. I honestly really didn't know about Zeta.
Yeah.
You kind of brought it up on my radar. And perfect opportunity for this dip, But I would say, let's put it this way. You probably said it the best way. You want to be buying when people aren't noticing. You want to be buying, when things are starting to turn up. And what I mean by that is, again, when they're growing fundamentally, they're executing on their plan. When people are, betting down on it, people see a drop and they get scared. Okay. They're not trying to execute and go long. But that is a time when you have to. I mean, look at UNH. You brought that example up. You could have got it under 300. It's 20 still?
Well, yeah.
Yeah.
And still super undervalued.
Yeah. It went to 248. Okay. And yeah, that was a scary time. I mean, literally that one went from 600 to 248. So yes, there was obviously crazy things going on there. But still, that is Warren Buffett says it. You want to be buying when people are fearful. And that's exactly what, I'm trying to take advantage of as well, because it's true. It really is true. And look at how it came out for, how it ended up for him.
Yeah. 100%. You know what I really love to see on stocks? I like to scroll back, and the 200 weekly moving average is such a pivotal, it's such a pivotal piece of the story of when to buy like when you're getting a really low risk to high reward and vice versa. So here we have to go back to 2009 on United Health to be able to find a time where they dipped a decent amount underneath that 200 week moving average. And then from 2009 to present day, you will see that every single dip below or at, like a bounce at the 200 week moving average, has been just a spring loaded, or a loaded spring.
Yeah.
And just a fierce, undercut then bounce, or a strong hit and bounce, right? Look at that. We hit that and then went back to all-time highs. And then again, just a little bit, just like what? The beginning of this year, we went under it and then we spring loaded back to almost all-time highs, right? Look how far. You want to say, oh man, I didn't get in at 250 and now it's 300. I missed it on $50. Okay. Well, look how far we are still underneath this 200 week moving average. We're still 38%. And the 200 week moving average is like a magnet, guys. As long as you're investing in a good, solid company, even sometimes when you're not, like it'll still be a magnet. Especially with like UNH, that is a dominator of the health insurance sector, right? Like I'm not gonna say what I was gonna say, but I would bet so much money that we see the 200 week moving average again on UNH.
Mm-hmm.
I'd bet like ungodly amount of money that we do, because they're not going anywhere. Their free cash flow is phenomenal. Their EPS, their net income, their margins, like, yeah, they're going through some headwinds right now, maybe some lawsuits, maybe some investigations. Okay. But this is the leading health insurance name in the entire United States.
Yeah.
They're not going bankrupt. This is absolutely insane. Their fair value is like $400 and some dollars. And you could see that they stayed in this range for a very long time. And then they broke out heavily. And now you're at the dip buy box. You're at this solid volume shelf, right? I can't really see us going down to 200. I mean, I would be smacking my lips if we went down to 200. I'd be just gobbling up shares down there because that is ridiculous. You're talking about a 3x. Like it'd get back to 600 and then you have a 3x on your hands. So yeah, guys, you're not going to time bottoms perfectly. You just have to sit here and ask yourself, okay, it's consolidating here. It's consolidating for a reason. It's either consolidating for another leg lower, or it's consolidating because people realize how deeply undervalued it is and it's about to retrace back to its 200 week moving average. And that's literally, what, 150, 250 bucks.
Yeah.
From where we are now. So just massively undervalued. And this is very similar, like to a lot of them. Zeta is the same thing. Zeta, we're not under the 200 week moving average, but it's right here. It's right here, down here at $12. So you're still getting a great deal at 15 when the 200 week moving average is at 12. You still have all this upside up here. And this is another one. Like, I don't think you should go buy a ton of money or like a ton of options for like short dated options. But if you want to nibble a little bit out there, because once, either OSCR gets some ACA news, or, their next earnings, they're supposed to report really good earnings like they usually do. Or like for Zeta, like they get some good news about the lawsuit and stuff. Once you get that, people are going to be like, oh, wow, this is undervalued and the risk is gone. And then boom, like it just explodes. And that's where you see people, get crazy gains on some of these options.
Yeah.
What was it yesterday? Datadog?
Datadog got into that
loaded.
500.
I missed that, sadly. Yeah. I think I found a new one that could do the same thing here. But here's another thing, guys. And we're not gonna talk about it too much yet, but me and Knots we're working on something big, working on something really, really big for the investing community. Maybe putting our heads together for something there. So stay tuned on that too, guys. I think it's gonna me and him are pretty giddy about it. But look at this, Datadog. You dipped down under that 200 week moving average. You based out, right? And then what happened? Boom, big explosion to the upside. You had good earnings. You started rocking higher. My indicator gave a buy signal before that. I clearly missed that. That's on me. because now we exploded to the upside. Went from 80 to 1. We doubled in a couple months. Crazy, guys. And the one that I think could do this now, MongoDB.
Mongo.
Yep. A lot of people know this name.
Yep.
So you can already see why the risk reward is so phenomenal here, right? You go back to 2019, and I know we're getting a little off topic here, guys, but whatever. We're just BSing around. The markets are closed, whatever. But look, 2019, get this consolidation. You break out, you retest it, you confirm it. That is created now as support, and now you have it as support again.
Yeah.
So the market and the technicals are telling you, hey, this was once resistance, but guess what? Now it's support, and there's tons of volume. So your risk is down to 140. We're at 211. Your reward is endless, basically. Your reward is all the way up to 500, maybe 600. And this is the same setup basically as Datadog. So I'm really looking at this one. Sadly, I didn't have enough time to get any options. I should have. Watch it explodes Monday because I just said this. But yeah, I think this one looks really good too. We talked about everything except for the stock that
oh yes. Oh wait. That's not.
Nope.
Oh well, is that the one you wanted? Because I know I got confused.
Yep.
Okay.
So Evercore. Evercore is the new high five gem that I found. I'll just pull up the high five snapshot. So this is essentially their. Dang it, I keep picking the wrong one. Now everybody knows the other one now. Yeah. Made it very, very obvious. The cat's out of the bag on the other one too. Oh well. So Evercore, massive. Dude, I just love their chart, honestly. And the business is severely undervalued. So, man, I'm everywhere right now. Where are we at on this? Have you done any research into this one yet?
I have not.
So I honestly again, guys, I'll be the first one to tell you, sometimes you're going to miss just great opportunities. But just because you missed the bottom doesn't mean you still can't grab onto the coattails of this name. So again, 200-week moving average, if you would have been buying this in April, I mean, you're up massive right now. You're up 100% on this name if you're grabbing it off the 200-week moving average in April. And it was very simple to realize, hey, look, we have all this consolidation. This is very strong support here dating back to 2021. Hit the 200-week moving average and just completely flip the script. So I'm a buyer here. I think we're going to break over these all-time highs, just like we did here. We hit all-time highs. We came down. Then we broke over them. Then we ran another, 150 to 300. I think we're doing the same thing here. Came down, breaking all-time highs, and I think we run to 400 or 500 on this name. Yeah. This is a financial sector name. So basically, they are in the investment banking, realm. And yeah, with the investment banking realm, I think, I don't know about you, Bull, but if we look at the QQQ, I think we're just going into another bull run. If we look back to 2020? Yeah.
Okay.
2020, we V-shaped. We broke back over all-time highs. We retested all-time highs, and then look at this run. I mean, we went on a massive run here, breaking over those all-time highs. We went on a 73% run on the QQQ. Now, going to present day, we V-shaped due to tariffs. We broke over all-time highs, and now I feel like we're about to go on another massive run here, get the 700 on the QQQ. That's what I'm seeing. Not in a straight line, guys. Definitely not in a straight line, but this is definitely what I'm seeing. The double top fears are basically over. The whole this is the top and then up we're back, and then it slightly comes right before we get to the top and then rolls over and then we go to a lower low. I don't really see that happening. Obviously, macroeconomics, anything can happen, but I don't know. I feel like this administration's kind of been proving themselves more and more lately, with some things. So, you can either say they're full of crap, and I'm not going to take them at their word, and I think this market's going to implode on itself, and their plan's going to go to crap in a handbasket, right? And if that happens, and if that's your camp, then you probably shouldn't be invested in any stocks, and you should probably be shorting the heck out of this market.
Yeah,
I'm not doing that. I'm gonna trust them, and because all the technicals are telling me to trust them as well. So the technicals are telling me to trust them. They've kind of proven themselves on things. I'm not getting political here, guys. Just being like open and honest of what I've been seeing. So, yeah, I mean the technicals are clearly screaming to us that we have higher to go. It's not going to be in a straight line, but yeah, things look very, very good here for the markets. Back to Ever, basically investment banking. So what I was trying to get with all that and go with that was essentially with Evercore being all about investment banking and being like, basically if the markets are going to go up and people are going to get more into investing, right? People are going to be making more deals. People are going to be buying more stocks, so on and so forth. You are going to get these types of companies that even like a T. Rowe Price or something like that. These investment firms and everything, they're going to make more money because more people are going to be like, oh my gosh, look at the stocks. They're going up and up and up. I need a financial advisor. I need this. I need that. Let me give you my money to manage. And then they get all these fees, right? Any bull market, these companies are going to make money hand over fist. It's during the bear markets that everybody's like, oh, this sucks. And they pull their money out, or they're not making as much money, so on and so forth, right? But to get down to the brass tacks, guys, I mean, I literally have a 12 terminal free cash flow on this, 20% free cash flow margin, 25% free cash flow margin for the last 5 years of this analysis. They're expected to grow revenues in the teens. And we get a fair value of $471, which is currently 39% undervalued. It was 40-some percent current margin of safety, last week when I shared it with the community. I mean, free cash flow yield of 8%, 5% forward, 30 current PE, 25 forward PE. PEG ratio is not the greatest. And then EPS is a buy all day. So you're looking at 471 fair value, and the current price is 287. And you're looking at a 10-year CAGR of 14.5%. If you base it off of EPS, you're looking at about 12%, which handily beats the 8 to 9% that you get in investing in the S&P 500 on average each year. To kind of go over some things, elite market and acquisition reputation, known for handling complete high-profile deals with precision, driving strong advisory fee growth, capital efficiency. Their return on invested capital is 32.25%. Return on equity is 29.12%, and a PEG ratio of 0.37. I might be wrong on this. Okay, no, yep, I'm wrong on this. So it was a 30% revenue growth. Well, it's higher now because I put this in here 2 weeks ago. Shareholder focus, 18 consecutive years of dividend growth and aggressive buybacks show commitment to returning capital. So believe it or not, this is a gem at $11 billion market cap, and you get a dividend. Wow.
Yeah.
You get it all.
Good. I got to look into that one.
Yeah, for sure. Yeah, I won't go through everything else here, guys. It's, there's some risks in here. I would say the weakness in your threats, it's going to be geopolitical. It's going to be the market's taking a dump. If that stuff happens, then this company's going to, get hit because people are going to pull their money out of investments and stuff like that. But, if you're going to invest in this company, I would definitely say you have to feel very bullish about this market. I think what this market's about to do is going to be a 2021-esque blow off top. That's truly what I'm thinking right now. I think it's going to be a 2021 blow off top moment. It's not going to be in a straight line. There's going to be ups and downs, but I do believe we're going to have that before we have any kind of bigger bear market or, crash or something like that. At the end of the day, you had 2022 crash, you had a bear market, you had 2020 crash due to COVID, you had 2022 bear market, right, due to rising rates, and then you had basically another correction. Yeah. Well, you had a correction with the Japanese trade crisis, the Japanese carryover trade.
Yep.
You had that crash in August of last year, and then you had the tariff crash of like over 20% on the Qs. That's a lot of crashing. That's a lot of like 20% drops in literally 4 or 5 years. You guys realize we only have we have a recession usually every 10 years. So typically that's going to go along with, a bear market. We basically, if you didn't know, in 2020, we technically were in a recession based on 2 negative quarters GDP growth, all that good jazz. So yeah, I mean, how many more crashes do you guys want? Like, that's where I'm at right now. It's like, how are we going to get more crashes? I understand that a lot of things maybe don't look the rosiest or whatnot, but we do have the Fed that can cut rates like that.
Yeah.
Okay.
And we're waiting on it.
And we're waiting on it. I do think they need to get started on that. But yeah. So yeah, guys. Yeah.
It's interesting. I mean, obviously Trump's been pushing. He's been talking trash about Powell. We'll see how things go. We'll see how things go.
Yep, we definitely will. Yeah, guys, I really like this company. It's no Oscar, it's no Zeta, but I mean, definitely can, I think, 2x in 1 to 2 years on this investment, which unless you're a degenerate gambler, you realize that's really, really good returns on your money. So yeah, I really like this company. There's others in there as well. I already spilled the beans on EverQuote, but which also deals with insurance. What's up with all these insurance companies, dude?
Yeah, I think I want to get away from the insurance industry, but I keep coming back to it.
I know. So good, man.
Like I'm in HIMS healthcare. I'm in Oscar, basically healthcare.
My portfolios are loaded in healthcare, but I feel like healthcare is such an undervalued sector right now. It's like you look at tech and it's like, we're back to all-time highs, and tech is pretty expensive again. It's not like it was in April. I already bought the dip in tech in April and in August of last year and in the bear market. So I'm good on like the dips on, what I mean? Do I really want to plunge more money into tech whenever it's not where it was when I was buying it? I'll DCA, but you got to keep looking for the newer sectors to go find, undervalued deals and stuff.
Yeah.
But I think that's it. I think we can wrap this thing up. Whoop.
What?
I was zooming in and out on us.
Oh.
But yeah, guys, we're gonna continue to do this every week. We got big plans cooking for something exciting on the investing side of things, because me and Knots do a lot of trading in our discords and stuff. So looking at maybe like a higher echelon investing type thing, putting our minds together and just creating something that really crushes it on a monthly, quarterly, yearly basis, where put this stuff on cruise control, man. Like I've showed it multiple times, buying that 200-week moving average, finding those good undervalued companies. Like, it could be just a cheat code, honestly. So yeah. I hope everybody has a great 4th of July weekend. If you didn't hit that like button during this whole time, I always forget to say it in the beginning. Hit that like button, share it with a friend, subscribe, follow me and Knots on X, me and X on Knots. Follow us. We provide many posts about Oscar and all these different companies that we're constantly finding out there. If you want to join me or Knots community, definitely do that as well. But yeah, guys, have a phenomenal 4th of July. Don't be an idiot. Don't drink and drive.
Everyone be safe.
Yeah, be safe. Like, it's not worth it. Even if it's not affecting you, might affect somebody else. So just don't put fireworks on your head. Don't be doing dumb stuff. Like, it's so many stories every year, man. So bad. So you got anything to say, Knots?
No. Hope everyone has a great 4th. Again, be safe. Obviously no market is closed tomorrow, so we will see you guys Monday. Well, market opens Monday.
Yep. See you guys Monday, and focus on getting a little learning done this weekend, and but overall just enjoy it. Have some hot dogs, burgers, have a couple brewskis. Just relax with family. That's all I'm be doing. Be posting a little bit less this weekend. Step away for a little bit. But appreciate you guys. See you in the next one. Have a great 4th. Peace.